Hey everyone, last week the new inflation numbers came out and they were a bit of a shocker, coming in at 9.1%, quite a bit higher than expected. That holds some implications for commercial real estate. First, it will certainly impact interest rates. Second, it could increase recession risks. And third, it could affect the flow of capital into different property types and to different areas of the country. Let's start with some numbers. Headline inflation for June was up 9.1%, the highest it's been in 41 years. The biggest contributor was energy prices, basically oil and gas. If you strip out the cost of energy and food, just looking at core inflation, the picture is a bit more promising. Core inflation was only 5.9%, and that's down 60 basis points from its peak in March. That tells us a lot. Basically, most of the inflation lift is in the energy sector. Prices of many commodities have been coming down. The price of lumber is down 49% from January. And since March, the price of steel has come down 41%, while the price of copper has fallen 33%. In addition, the cost of shipping a container from China has fallen to $7,400 from its peak above $20,000 last September. That's a big drop, but it still costs about 5 times more to ship a container from China than before the pandemic when it was $1,400. Another important movement has been the recent decline in gas prices. Gasoline peaked in June at $5.11 per gallon. Since then, it has come down about 10% to $4.61 a gallon. So it looks like the inflationary pressure may be leveling off, but we're not in the clear yet. There are still a lot of variables, most significantly the war in Ukraine and that conflict's potentially volatile effects on oil and food prices. And even if inflation is starting to roll back, it's still really high. So the Fed needs to take additional action. On July 27th, the Federal Reserve will announce its next rate movement. A 75 basis point increase is pretty much baked in, but the 9.1% inflation number that just came out may have scared the Fed a bit, and they could go for a 100 basis point increase like the Canada Central Bank did last week. That's putting upward pressure on short-term interest rates, but at the same time, blinking recession indicators are spooking Wall Street. That's putting downward pressure on the stock market and in turn driving long-term interest rates like the 10-year Treasury lower. As a result, the yield on the 2-year Treasury has risen above the yield of the 10-year Treasury, creating an inversion, a commonly recognized signal of an impending recession. But as I've pointed out in the past, a better indicator is the 3-month Treasury versus the 10-year, and although that spread is tightening, it has not inverted. Remember, a yield curve inversion is not a bulletproof indicator that a recession is coming. There have been false positives. For commercial real estate, the inflationary and financial market turbulence is generating 5 important trends. First, capital is moving to investments that are perceived to be less volatile, like commercial real estate. Second, interest rates are still seeing upward pressure, but balance sheet lenders like banks and credit unions may continue to offer lower rates than credit market lenders like CMBS. Third, the most inflation-resistant commercial real estate property types like hotels, apartments, and self-storage remain in favor. Fourth, capital is also targeting commercial properties like suburban office, retail, and industrial properties that either have a built-in rent escalator or where the in-place leases are set to expire in the near future. And fifth, capital flows are migrating from the markets that were most in demand over the last year to higher yield secondary and tertiary markets. That likely means sustained competition for assets in the Midwest and in smaller cities. Although many believe that rising interest rates will slow the commercial real estate investment market and put upward pressure on cap rates, we have to remember that there's a lot of capital out there looking for the durable, inflation-resistant returns offered by real estate. Although commercial real estate capital may shift in terms of the preferred assets or the preferred markets, as a whole, the sector remains compelling compared to alternative investment options. That's why investors need to look at the bigger picture and keep their eyes on the horizon.